If you have ever sat down and looked at your savings or your investment account and felt a quiet, unsettling sense of uncertainty about whether you are truly doing the right things with your money, you are in exactly the right place, and what you are about to hear is made specifically for you. Every single day, across every continent and in every currency, millions of hardworking, intelligent people face the same overwhelming challenge. They earn money through effort and sacrifice. They manage to save some of it, sometimes painfully and with great discipline. And then they face a world of dizzying financial noise, contradictory expert opinions, confusing investment products, and a financial industry that often profits most when its customers understand the least. The result, for most people, is a financial life that is far less efficient, far less organized, and far more stressful than it ever needs to be. Most investors spend decades making avoidable mistakes, paying unnecessary fees, chasing returns that disappear just as they arrive, and selling their investments in panic at exactly the wrong time. They work hard, they save diligently, and yet after years and decades of investing, they find themselves with far less wealth than they should have accumulated, not because the markets failed them, but because nobody ever taught them how investing actually works. But there is a better way. There is a way of thinking about your money, your investments, and your financial future that is grounded not in guesswork, not in speculation, and not in the hope of finding some magical stock that will make you rich overnight. It is a way grounded in decades of real financial history, in mathematical evidence, and in the careful scientific study of how markets actually behave over long periods of time. That way of thinking is what the brilliant financial researcher and author William Bernstein spent years of serious study developing and refining into a framework that any ordinary investor, anywhere in the world, can understand and apply. That framework is intelligent asset allocation. And today, we are going to walk through every major idea in his landmark work on this subject, piece by piece, layer by layer, in plain and simple language that does not require any financial background, any mathematics degree, or any previous investing experience to understand and use. This is not just financial theory. This is a practical guide to building real wealth with genuine confidence and true intelligence. This is a journey through one of the most important and thoroughly evidence-based works ever written for the ordinary investor, and by the time we reach the end of it, you will have a clarity about money and investing that most people never achieve in a lifetime. So let us begin. Let us start at the very beginning, at the absolute bedrock of everything that Bernstein teaches, and that bedrock is the fundamental relationship between risk and return. Risk and return are the two most important concepts in all of investing, and they are absolutely inseparable from each other. You cannot meaningfully discuss one without discussing the other. The basic principle, stated as simply as possible, is this: higher potential returns always come with higher risk. There is no free lunch in financial markets. If someone is promising you a very high return with very low risk, something is wrong with that promise, because the mathematics of well-functioning markets simply do not permit it over any meaningful period of time. This is not an opinion. This is not a theory. It is a mathematical and economic reality that has been demonstrated consistently across virtually every market in virtually every era of financial history. Now, before we go further, we need to make sure we understand what risk actually means in the context of investing, because most people use the word loosely and imprecisely, and that imprecision leads to confusion and poor decisions. In the world of financial science, risk has a precise meaning. Risk is most commonly measured using a concept called standard deviation. Now, do not let that term cause any concern. Standard deviation is simply a measurement of how much an investment's returns tend to jump around from year to year compared to its average. Think of it this way. Suppose you have two very different investments. The first one, year after year, returns something between 8 and 12 out of every 100 units that you have invested. Some years it is 8, some years it is 12. but it never strays far from that range. This investment has low standard deviation. Its returns are relatively predictable and stable. Now, the second investment is very different. In some years, it gains 40 or even 50 out of every 100. In other years, it loses 20 or 30 out of every 100. Its returns swing wildly and unpredictably from year to year. This investment has high standard deviation. Its returns are volatile and hard to predict. Now here is the crucial insight that everything else builds upon. Historically, across all the major investment markets and across all the long periods of history that financial researchers have studied, the investments with higher standard deviations, the more volatile ones, have also delivered higher average returns over long periods of time. And the investments with lower standard deviations, the more stable ones, have delivered lower average returns. This pattern is not a coincidence. This is precisely how markets are supposed to work. Here is the logic behind it. When you invest your money, you are taking a risk. You are accepting uncertainty about your future return. The more uncertainty you accept, the more you can potentially earn, because investors who are willing to bear more uncertainty demand more compensation for doing so. If a risky investment did not offer higher expected returns than a safe one, no rational investor would ever buy it. Everyone would simply put all their money in the safest available investments. This would push up the prices of safe investments and push down the prices of risky ones, until the risky investments once again offered sufficiently higher expected returns to attract buyers. The market, in other words, continuously reprices itself until risk is properly compensated. This is the deep logic behind the risk and return relationship, and understanding it completely changes how you think about building a portfolio. It means that the question you should be asking is never simply, how do I maximize my return? The truly intelligent question is, how much risk am I genuinely willing and able to bear, and how do I get the best possible return for that specific level of risk? This is the question that intelligent asset allocation is designed to answer. And now, with this foundation firmly in place, we can begin exploring the different types of investments available to you, what their historical records look like, and how combining them in intelligent ways creates something more powerful than any single investment could be on its own. Let us start with the most important asset class for long-term wealth building, and that is equities, which simply means stocks or shares of ownership in companies. When you own a stock, you own a small but real piece of an actual business. You have a claim on that business's future earnings, its assets, and its growth. When the business prospers, your ownership stake becomes more valuable. When the business struggles, your ownership stake becomes less valuable. Over very long periods of time, broadly diversified investments in stocks have been the highest returning major asset class available to ordinary investors. The reason for this is fundamentally grounded in the nature of business and economic growth. Companies, when taken collectively across a broad economy, tend to grow their earnings over time. They do this because economies expand as populations grow, as technology improves productivity, as trade increases, as companies find better and more efficient ways of serving customers. This underlying growth in real economic output translates, over time, into growing corporate earnings, and growing corporate earnings translate into rising stock prices and increasing dividends. This is why, despite all the terrifying short-term fluctuations, stocks have been the greatest engine of long-term wealth creation in the history of modern finance. But this extraordinary long-term return comes with a price, and that price is volatility. Stocks can, and regularly do, fall by 30, 40, 50, or even more out of every 100 units of their total value in a relatively short period of time. History is full of these frightening episodes. During the Great Depression of the 1930s, the American stock market fell by nearly 90 out of every 100 of its value from peak to trough. During the technology bubble collapse of the early 2000s, the Nasdaq Composite Index fell by roughly 80 out of every 100 from its peak. During the global financial crisis of 2008 and 2009, broadly diversified stock portfolios lost somewhere between 40 and 50 out of every 100 of their value in about 18 months. Each of these periods was genuinely terrifying for investors who lived through them. Financial news during these times was filled with predictions of permanent disaster. Intelligent, experienced investors sold everything in panic. Companies and banks were genuinely failing. The future looked very dark indeed. And yet, here's what Bernstein wants you to understand with absolute clarity. Every single one of those terrible periods was eventually followed by a full recovery and a return to new highs. The investors who maintained their positions through the darkest days, who continued to invest their regular contributions at devastatingly low prices, who did not sell when their emotions were screaming at them to do so, were ultimately rewarded with excellent long-term results. The investors who panicked and sold near the bottom locked in their losses permanently and missed the recovery that followed. This pattern, the terrifying crash, followed by the inevitable recovery, followed by new highs, has repeated itself consistently throughout the entire history of financial markets across virtually every major economy in the world. It is not a guarantee about the future, but it is one of the most consistent patterns in all of financial history. And understanding it, truly understanding it at a deep level, is one of the most valuable things you can do for your long-term investment results. Now let us turn to the second major asset class, which is bonds. When you buy a bond, you are lending money to a government or a corporation. In exchange for that loan, the borrower promises to pay you a defined rate of interest for a defined period of time and to return your original principal at the end of that period. Bonds are generally considerably less volatile than stocks. Their prices do not swing as dramatically from year to year. And for most investors in most circumstances, holding bonds in a portfolio reduces overall portfolio volatility significantly. But bonds also carry lower long-term expected returns than stocks. Over long periods of time, high-quality bonds have historically delivered returns meaningfully below what stocks have delivered. This makes perfect sense through the lens of the risk and return relationship. Because bonds are less risky than stocks, they are priced to offer lower returns. The market compensates bond investors less because they are bearing less uncertainty. Now, it is important to understand that bonds are not without their own distinctive risks. The first significant risk of bonds is interest rate risk. When interest rates in the broader economy rise, the prices of existing bonds fall. Here is why. If you hold a bond paying you 5 out of every 100 as interest, and new bonds come to market offering 7 out of every 100, your bond becomes less valuable. Why would anyone buy your 5 out of every 100 bond at full price when they could buy a new bond paying 7 out of every 100 instead? To attract a buyer, you would have to sell your bond at a discount. This inverse relationship between interest rates and bond prices is one of the most fundamental dynamics in fixed income markets. The second significant risk of bonds is inflation risk. If inflation rises faster than the interest rate your bond is paying, you are actually losing real purchasing power even while you collect your seemingly attractive interest payments. A bond that pays you 4 out of every 100, while inflation is running at 2 out of every 100, is delivering a real return of 2 out of every 100. But a bond that pays you 4 out of every 100, while inflation rises to 6 out of every 100, is actually destroying your purchasing power at 2 out of every 100 per year, even though you are receiving those regular interest payments. The third risk, which is most relevant for corporate bonds and bonds from financially stressed governments, is credit risk. This is the risk that the borrower may not be able to make the promised interest payments or return the principal when it is due. Companies can go bankrupt. Governments, particularly in some parts of the world, have historically defaulted on their debts. When this happens, bond investors can lose a significant portion of their investment. Despite these risks, Bonds play a genuinely important and irreplaceable role in a well-constructed investment portfolio, and we will explore exactly why in more depth as we continue. The third major category, worth understanding, is cash and short-term instruments. This includes money held in bank savings accounts, money market funds, and very short-term government securities. Cash is the most stable of all the major asset classes. Its nominal value barely changes at all in the short term. If you put 1,000 units of currency in a savings account, you will have roughly 1,000 units plus a small amount of interest tomorrow, next week, and next month. The nominal value is essentially fixed. This apparent safety makes cash feel very comfortable. But Bernstein wants investors to understand a profound and often overlooked truth about cash. Over long periods of time, after accounting for inflation, cash has historically been the worst performing major asset class. In many historical periods, the real return on cash, meaning the return after subtracting inflation, has been zero or even slightly negative. The money you keep in a savings account is often barely keeping pace with rising prices, and sometimes not even that. This means that for money you are setting aside for long-term goals, for retirement decades away, for building lasting wealth over time, holding too much of it in cash is not a safe strategy. It is actually a slowly but surely losing strategy. The real risk of excessive cash holdings is not that your account balance will suddenly fall. It is that the purchasing power of your money will gradually and silently erode year after year as inflation does its patient, invisible work. Many investors make the mistake of thinking they are being cautious and safe by keeping large amounts in cash. In reality, they are accepting a high probability of failing to meet their long-term financial goals in exchange for short-term comfort. Understanding this is fundamental to thinking about investing correctly. Now, beyond these three basic asset classes of stocks, bonds, and cash, there are several other important categories that Bernstein discusses, each with its own distinctive characteristics and its own role in a well-constructed portfolio. Real estate, accessed through what are called real estate investment trusts, provides exposure to property markets without requiring you to buy, manage, or sell physical property. These are companies that own and operate large portfolios of income-generating real estate, such as apartment buildings, office towers, shopping centers, industrial warehouses, data centers, and healthcare facilities. They are required by law in most jurisdictions to distribute the majority of their income to shareholders, which makes them an attractive source of regular income. Real estate investment trusts have historically had return patterns that are somewhat different from both stocks and bonds, which means they provide genuine diversification benefits when added to a portfolio. International stocks, both from mature developed economies and from rapidly growing emerging economies, provide exposure to parts of the global economy that may not move in perfect lockstep with your home country's market. Different countries, different currencies, and different economic cycles mean that international stocks often behave differently from domestic ones, providing valuable diversification. Small company stocks have historically delivered higher long-term returns than large company stocks, though with greater volatility and requiring considerably more patience from investors. Value stocks, meaning stocks that appear cheap relative to their underlying financial fundamentals, have also historically outperformed their more expensive counterparts over long periods. Each of these categories has a distinctive risk and return profile, and the genius of intelligent asset allocation lies in combining them in a way that produces a portfolio with the best possible return for the level of risk you are willing to accept. But how does combining different asset classes actually reduce risk? This is where things become truly fascinating, and where Bernstein reveals the most powerful principle in all of portfolio construction. The key concept here is correlation. Correlation measures how closely the returns of two different investments tend to move together over time. When two investments have a high positive correlation, it means they tend to rise and fall at roughly the same times and by roughly similar amounts. When two investments are uncorrelated, it means their movements are largely independent of each other. When two investments have a negative correlation, it means they tend to move in opposite directions. When one goes up, the other tends to go down, and vice versa. Here is why this matters so profoundly for portfolio construction. If you put all of your money into a single investment, your portfolio rises and falls entirely with that one investment. Every movement, up or down, in that investment is fully reflected in your portfolio value. But if you put your money into several different investments that are not perfectly correlated with each other, something mathematically remarkable happens. When one investment is falling, another may be holding steady or even rising, cushioning the impact. The result is that your overall portfolio is less volatile than any single investment within it. Your ups are not as high, but your downs are also not as low. And crucially, this reduction in volatility does not require a proportional reduction in expected return. This is what makes diversification so powerful. This is not just a theory, it is a mathematical certainty that follows directly from the way correlation works. When you combine investments that are imperfectly correlated, the combined portfolio has lower volatility than a weighted average of the individual volatilities of its components. This mathematical property means that diversification genuinely creates something valuable. It creates portfolios that offer better returns per unit of risk than any single investment could offer on its own. Let us make this completely concrete with a very simple example. Imagine two investments. Investment A does very well during economic boom periods, when consumers are spending freely and businesses are investing and expanding. But it suffers badly during economic recessions. Investment B, on the other hand, consists of businesses that people need regardless of economic conditions, perhaps utilities, basic consumer goods, or healthcare. It holds its value reasonably well during recessions, but grows more slowly during boom periods. If you hold only investment A, your portfolio soars during good economic times, but falls hard when the economy slows. If you hold only investment B, your portfolio is relatively stable, but grows slowly even during the best of times. But if you hold both A and B together in your portfolio, something interesting happens. During recessions, investment B provides a cushion that reduces the overall damage to your portfolio. During boom times, investment A drives significant gains even though investment B lags a little. The combined portfolio does not reach the absolute highest highs of investment A during boom times, but it also does not suffer the lowest lows of investment A during recessions. And when you calculate the overall return relative to the overall volatility of the combined portfolio, it is often better than either investment alone. You get a better trade-off between return and risk from the combination than from either investment in isolation. This is the fundamental principle of portfolio construction, and it is the concept that William Bernstein calls the efficient frontier. The efficient frontier is a concept originally developed by Nobel Prize-winning economist Harry Markowitz in the 1950s, and it is one of the most important intellectual pillars of modern investment theory. Bernstein builds much of his practical framework on this foundation. Here is how to think about the efficient frontier. Imagine that you take every conceivable portfolio you could build using a specific set of asset classes, every possible combination of stocks, bonds, cash, real estate, domestic, international, large cap, small cap, every possible proportion of each, and you place each of these portfolios on a graph. On one axis of the graph, you measure risk, specifically measured as standard deviation of returns. On the other axis, you measure expected return. Each dot on this graph represents a different portfolio with a different combination of assets. Some portfolios are very risky with high expected returns, sitting toward the top right of the graph. Some portfolios are very conservative with low expected returns, sitting toward the bottom left. And some portfolios, the ones no investor should ever want, are high risk with low expected returns, meaning they are taking a lot of risk without being properly compensated for it. Now, if you draw a smooth curve along the upper left edge of all these dots, that curve traces out the portfolios that offer the highest possible expected return for any given level of risk. Equivalently, it traces out the portfolios that offer the lowest possible risk for any given level of expected return. That curve is the efficient frontier. Any portfolio that sits on this frontier is an efficient portfolio, meaning you cannot improve it without either accepting more risk to get more return or accepting less return to reduce risk. Any portfolio that sits below this frontier is inefficient, meaning it could be improved either by getting more return for the same risk or by taking less risk for the same return. The entire goal of portfolio construction, from Bernstein's perspective, is to build a portfolio that sits as close as possible to the efficient frontier. And the most powerful way to move toward the efficient frontier is through intelligent diversification across asset classes that are not perfectly correlated. Now, an important caveat that Bernstein is careful to include. The precise mathematical location of the efficient frontier depends on future correlation and return assumptions. And future correlations and returns are unknown. They can only be estimated based on historical data and economic reasoning. Historical correlations are imperfect guides to future correlations. They change over time, sometimes dramatically, particularly during market crises when many asset classes that normally move independently can suddenly become much more correlated as panic spreads. So the efficient frontier is best understood as a conceptual framework for thinking about diversification and portfolio construction rather than a precise mathematical recipe that can be optimized to the decimal point. It tells you that broadly diversifying across imperfectly correlated asset classes will improve your portfolio's risk-adjusted characteristics. It does not tell you with perfect precision what the ideal portfolio is. This humility about the limits of mathematical precision is itself an important part of Bernstein's philosophy. With this framework in mind, let us now turn to what history actually tells us about the returns and risks of different asset classes. Understanding the historical record is not about predicting the future with certainty. It is about calibrating your expectations, building a reasonable framework for planning, and gaining the confidence that comes from understanding how markets have behaved across many different economic environments over long periods. Bernstein draws on a rich body of historical data spanning many decades and many countries in building his analysis. The United States stock market, taken as a broadly diversified whole, has returned something in the range of 9 to 10 out of every 100 per year on average over the long sweep of financial history. But let us be very clear about what this average means. In any given year, stock returns have varied enormously from that average. There have been years when the market gained 30, 40, or even more out of every 100. There have been years when it lost 20, 30, 40, or more out of every 100. The average of around 9 to 10 emerges only after many years of wildly varying individual annual returns are combined and smoothed out. In any single year, the actual return can be anywhere across a very wide range. This is what high standard deviation looks like in practice. The key to capturing the long-term average return of the stock market is holding on through all of those individual years, including the terrible ones, without selling. An investor who sold every time the market dropped significantly would have missed out on enormous portions of the long-term return. For bonds, the historical record in the United States shows long-term returns roughly in the range of 3 to 5 out of every 100 per year, depending on the type of bond and the time period examined. This is considerably lower than the stock market return, consistent with the lower risk that bonds offer. For cash and short-term instruments, long-term historical returns have been in the range of 2 to 3 out of every 100 per year, often only barely staying ahead of inflation. These historical return numbers are not predictions of what will happen in the future. They are calibration tools. They tell you roughly what the risk and return trade-off has looked like historically, and they provide a foundation for thinking about reasonable long-term planning assumptions. Now, let us explore the historical record of some of the other important asset classes that Bernstein discusses. Small company stocks, as a category, have historically outperformed large company stocks over long periods. This additional return that small company stocks have delivered above the broad market is often called the small cap premium. The magnitude of this premium has varied considerably across different time periods and different markets. In some periods and countries, it has been significant. In others, it has been small or absent. But across many markets and many decades of data, the premium has been real on average. The most widely accepted explanation for why this premium exists returns to our fundamental principle of risk and return. Small companies are riskier than large companies in several important ways. They typically have less access to capital markets. They have less geographic and product diversification. They are more vulnerable to economic downturns, competitive challenges, and management failures. They are more likely to face genuine financial difficulty or outright failure. Investors who are willing to bear these extra risks demand extra compensation. And the market has historically, over long periods, provided that extra compensation in the form of higher returns. But here is something absolutely critical to understand about the small cap premium. It is not something that shows up reliably in every single year or even every single decade. There are extended periods, sometimes lasting many years, when small company stocks significantly underperform large ones. Growth stocks from large, well-known companies can dominate the returns of the broad market for a decade, while small company stocks struggle. An investor who adds a tilt toward small company stocks to their portfolio must be genuinely prepared to look at their portfolio underperforming a simple, large company index for potentially many years before the long-term premium reasserts itself. Most investors, when tested by this reality, find that they do not actually have the patience they thought they had. They see their tilted portfolio lag behind, and they abandon the tilt, often at exactly the wrong moment. This behavioral challenge is one of the most important reasons why adding asset class tilts to a portfolio requires not just intellectual agreement with the evidence, but deep psychological preparation for extended periods of underperformance. Value stocks tell a very similar story. A value stock is a stock that appears cheap relative to its underlying financial fundamentals. Different measures of cheapness are used, including the price relative to earnings, the price relative to book value of the company's assets, and the price relative to dividends paid. Whatever measure is used, the historical evidence across many markets and many decades consistently shows that stocks that are cheap relative to these measures have tended to outperform stocks that are expensive relative to them over long periods. The most popular explanation for the value premium also comes back to risk. Value stocks are often cheap because there is something wrong, or at least uncertain, about the underlying business. The company might be in a struggling industry. It might be dealing with operational challenges. It might have a management that the market does not trust. Investors who are willing to buy these ugly, unloved, uncertain businesses take on extra risk relative to buying the highly admired, fast-growing, exciting companies that everyone loves. And the market has historically compensated them for this extra risk with extra return. But just like the small cap premium, the value premium does not always show up reliably in every period. There are extended times when growth stocks dramatically outperform value stocks. The late 1990s saw enormous outperformance by technology growth stocks relative to value stocks. Similar periods have occurred in other eras. The investor who commits to a value tilt must have the genuine patience and conviction to maintain that tilt through these frustrating periods. This requires not just intellectual conviction, but the kind of deep understanding of the evidence that makes it possible to hold on when short-term results are discouraging. Bernstein discusses the evidence for both the value premium and the size premium with nuance and care, acknowledging both the strength of the historical data and the genuine uncertainty about whether and to what extent these premiums will persist in the future. His conclusion is that a modest tilt towards small cap and value stocks may be warranted for investors who deeply understand the evidence, genuinely believe it will continue over the long run, and have the psychological preparation to maintain the tilt through potentially long periods of underperformance. But for investors who cannot meet all three of those conditions, a simple, broadly diversified market portfolio without tilts is entirely appropriate and will likely deliver excellent results over time. International diversification is another major theme that Bernstein addresses with considerable depth. For investors in the United States and other large, well-developed markets, there is a common and understandable tendency to concentrate investments heavily in the domestic market. The home market is familiar. The companies are well known. News and analysis are abundant. And during periods when the domestic market is performing well, international diversification can feel like an unnecessary complication. But Bernstein presents compelling historical evidence that international diversification provides genuine and significant benefits. Different countries' stock markets have historically had different cycles. They are influenced by different economies, different monetary policies, different demographic trends, and different industry structures. What booms in the United States does not necessarily boom in Europe or Asia at the same time. What struggles in one country often flourishes elsewhere. In the 1980s, Japanese stocks were among the best performing in the world, dramatically outpacing United States stocks. Then, in the 1990s, Japan entered a prolonged decline that lasted for decades, while United States stocks soared. In the 2000s, emerging market stocks delivered extraordinary returns, while United States stocks had a lost decade. In the 2010s, United States stocks dominated global returns, while much of the rest of the world lagged. No investor can reliably predict in advance which country's market will be the best performer over the next decade. This is precisely why holding a mix of domestic and international stocks in proportions that reflect the global distribution of investable capital is the most prudent approach. You are not betting on any single country. You are investing in the broad global economy and capturing returns from wherever they happen to emerge. Beyond reducing the risk of concentration in a single country's economic fortunes, international diversification also provides currency diversification. Holding assets in different currencies means that movements in any single currency have a less dramatic impact on your overall portfolio. This is particularly important for investors whose home currency is susceptible to inflation or political instability. Bernstein recommends meaningful allocations to international developed market stocks as a standard component of any well-diversified portfolio. A reasonable approach for many investors is to hold something like a quarter to a third of their total stock allocation in international stocks, though the exact proportion can vary based on individual circumstances. For investors whose home country represents only a small fraction of global economic output, the case for international diversification is even stronger, and higher allocations to international stocks may be appropriate. Emerging market stocks deserve specific attention. These are the stocks of companies listed in developing economies, places that are transitioning from low-income to middle-income status, building more sophisticated financial systems, and integrating more deeply into the global economy. Countries like India, China, Brazil, South Korea, Taiwan, Indonesia, and many others fall into this category. Emerging market stocks have historically delivered some of the highest long-term returns of any stock market category globally. The reasoning is straightforward. These economies are growing faster than mature developed economies. The companies in them are often starting from a lower base and growing rapidly. The potential for wealth creation over long periods is enormous, but emerging market investments come with commensurately higher risks. Political risk is a serious concern in many emerging market countries. Governments can change policies abruptly, nationalize industries, impose capital controls, or engage in actions that harm foreign investors. Currency risk is another significant factor, as emerging market currencies can experience dramatic devaluations. Corporate governance standards are often weaker than in developed markets, meaning that shareholders have less protection against management misbehavior. And the markets themselves can be less liquid and more volatile than developed market stocks. All of these factors mean that individual emerging market country investments can be extremely volatile and sometimes result in devastating losses. Diversifying across a broad basket of emerging market countries, rather than concentrating in any single one, mitigates but does not eliminate country-specific risks. Bernstein suggests a modest allocation to emerging markets within the international stock portion of a portfolio, small enough that a disaster in any particular emerging market country would not devastate the overall portfolio, but meaningful enough to participate in the genuine growth potential these markets offer. Now let us turn to one of the most important practical concepts in Bernstein's entire framework, the concept of rebalancing. Rebalancing is the discipline of periodically adjusting your portfolio back to your intended target asset allocation after market movements have caused it to drift away from that target. Here is a concrete example of how it works. Suppose you decide on a portfolio with 60 out of every 100 in stocks and 40 out of every 100 in bonds. You invest your money accordingly, with 6 units of every 10 going to stock funds and 4 units of every 10 going to bond funds. Now imagine that stocks have an excellent year and rise substantially, while bonds remain relatively flat. By the end of the year, your portfolio might have naturally shifted to 70 out of every 100 in stocks and only 30 out of every 100 in bonds, simply because the stock portion grew so much more than the bond portion. Your portfolio has drifted significantly from your intended 60 to 40 split. To rebalance, you would sell some of your stock funds and use the proceeds to buy more bond funds, returning the portfolio to its intended 60 to 40 allocation. Alternatively, if you are still adding new money to your portfolio, you might direct your new contributions entirely to bond funds until the allocation returns to target, avoiding the need to sell anything. Now here is the key psychological challenge with rebalancing that Bernstein wants you to prepare for. It almost always feels wrong. When stocks have been rising, selling some of your stock funds feels counterintuitive. Your stocks are doing so well, why would you sell them? And buying more bonds at a time when they have been lagging feels equally uncomfortable. You are buying the laggard and selling the winner. This goes against every short-term instinct an investor has. But look at what you are actually doing when you rebalance. You are selling assets after they have risen in price and buying assets after they have fallen or lagged in price. You are, in fact, systematically selling high and buying low. This is exactly what every investor knows they should do, and almost no one actually manages to do in practice. Rebalancing provides a systematic, disciplined, emotion-free mechanism for doing exactly that, built right into your routine portfolio maintenance. The mathematical evidence shows that portfolios that are regularly rebalanced typically outperform otherwise identical portfolios that are never rebalanced, and this outperformance comes not from any sophisticated strategy or market insight, but simply from the mechanical discipline of maintaining your target allocation. The outperformance can be meaningful over long periods. Some research suggests that regular rebalancing can add somewhere between half and 1 full unit out of every 100 per year to long-term returns compared to never rebalancing, which over decades of investing compounds into a very substantial additional sum of wealth. Beyond the return benefit, rebalancing also serves a critical risk management function. Without rebalancing, your portfolio can gradually drift to become far riskier or far more conservative than you originally intended. After several years of strong stock market performance without rebalancing, what started as a moderate portfolio might have drifted to become highly aggressive, leaving you far more exposed to the next inevitable market downturn than you planned for or can psychologically tolerate. When that downturn eventually comes, as it always does, an investor with a heavily overweighted stock allocation due to drift will experience much larger losses than expected, which is precisely the scenario most likely to trigger panic selling. Regular rebalancing prevents this dangerous drift and keeps your risk level genuinely aligned with your intentions, your goals, and your temperament. How frequently should you rebalance? There is no single perfect answer. Rebalancing too frequently generates unnecessary trading costs and, in accounts that are subject to taxation, can create unwanted tax liabilities as gains are realized. Rebalancing too infrequently allows the portfolio to drift substantially from its intended allocation. A reasonable middle ground for most investors is to check the portfolio once or twice a year and rebalance if any major asset class has drifted more than 5 to 10 out of every 100 from its target allocation. Another sensible approach is to use new contributions when they are being made to rebalance by directing new money to whichever asset classes are currently below their target, reducing or eliminating the need to sell anything. In tax-advantaged retirement accounts, where there is no tax cost to selling and buying, rebalancing can be done more frequently without any tax penalty. In taxable accounts, more thought should go into the tax implications before triggering rebalancing trades. Now let us address one of the most sobering and ultimately most important topics in all of investment education: the topic of investor behavior, and specifically, why most investors consistently earn far less than the investments they are invested in actually deliver. This seems like it should be impossible. If you invest in a fund that simply tracks a market index, should you not earn roughly what that market index earns? In theory, yes. But study after study has found that the average investor in virtually any fund earns significantly less than the fund itself earns over the same period. The culprit is behavior. Here is what the research consistently shows. When markets are rising and funds are producing exciting returns, investors pour money into those funds at elevated prices. The news is good, the returns are impressive, everyone seems to be making money, and the temptation to add more is irresistible. When markets fall and funds lose value, many investors panic and sell their positions. The news is terrible. The future looks bleak. Every additional day seems to bring more losses, and the emotional pain of watching wealth evaporate becomes unbearable. The net result of this completely natural but completely destructive pattern is that the average investor consistently buys at high prices and sells at low prices, precisely the opposite of what they intellectually know they should be doing. The gap between what the market delivers and what the average investor actually receives is called the behavior gap. Research has documented this gap across many countries, many time periods, and many types of investments. The behavior gap can easily cost investors 1 to 3 out of every 100 units of return per year, which sounds small in any single year, but compounds over decades into an enormous and entirely self-inflicted reduction in final wealth. An investor who earns 7 out of every 100 per year instead of 9 out of every 100 over 30 years of investing ends up with a dramatically smaller portfolio, not because the markets failed them, but because their own behavior sabotaged their results. Bernstein is deeply concerned about this problem, and understanding and overcoming the behavior gap is one of the central themes of his work. His fundamental argument is that the best protection against the behavior gap is knowledge. Specifically, it is the kind of deep, historically informed, mathematically grounded knowledge that allows you to maintain perspective and composure when markets are doing frightening things. An investor who knows, from having studied financial history, that every market crash in recorded history has eventually been followed by a recovery, who knows that short-term volatility is simply the price of long-term outperformance, who understands the mathematical certainty of diversification's benefits, and who has internalized the irrelevance of short-term market movements to long-term wealth building. That investor is psychologically equipped in a way that most investors are not. They can look at a market that has fallen 30 out of every 100 and feel, not terror, but a kind of measured equanimity, even recognition that lower prices mean more shares purchased with their regular contributions. They can stay the course. They can even add to their positions at the bottom. And over the long run, this behavioral advantage compounds into a financial advantage that is just as real and just as powerful as any sophisticated investment strategy. Let us explore some of the specific behavioral biases that Bernstein identifies as particularly dangerous to long-term investors. The first, and perhaps most pervasive, is recency bias. Recency bias is the deeply human tendency to give recent events far too much weight in our predictions about the future. When stocks have been rising for 3, 4, or 5 years, most investors project that upward trend forward. They see the recent performance, they conclude that it will continue, and they become overly optimistic about the future. They often add money to stocks precisely when valuations are highest and forward returns are lowest. When stocks have been falling for a prolonged period, the same mental pattern works in reverse. Investors project the recent decline forward, conclude that worse is still ahead, and they sell exactly when valuations are cheapest and forward returns are likely to be highest. Recency bias is the primary force that drives investors to buy high and sell low. It is why markets often reach their most extreme overvaluation just before major corrections, as optimistic investors pile in. And it is why the darkest moments of bear markets, when prices are lowest and forward returns are highest, are exactly when most investors are the most frightened and the most prone to selling. Understanding this bias does not make you immune to it. It is baked into human psychology. But awareness of it, combined with a deeply held understanding of investment history and principles, can help you resist its most destructive manifestations. The second major bias is overconfidence. Human beings in general, and investors in particular, dramatically and systematically overestimate their ability to predict the future. Most people, when asked whether they are better than average drivers, say yes. Most investors, when asked whether they can pick stocks that will outperform, believe they have some useful edge. Most people who watch financial news believe that they can identify which way the market is heading. The evidence is absolutely clear that this overconfidence is almost universally unfounded. Study after study has shown that the vast majority of individual investors who attempt to pick stocks or time the market underperform the market index significantly over time. And professional investors are not much better. The evidence consistently shows that roughly 80 out of every 100 actively managed funds underperform their benchmark index over periods of 10 years or more, after all fees and costs are accounted for. The small minority that do outperform in one period show very little persistence in the next. If even full-time professional investment managers, with access to enormous research resources and sophisticated analytical tools, cannot reliably beat the market, what is the basis for believing that individual investors, working with limited time and information, can do better? Acknowledging this uncomfortable truth is not an admission of defeat. It is an act of financial intelligence. It frees you from the expensive and futile pursuit of trying to beat the market and allows you to focus your energy on the things that actually do make a difference in long-term investment results, namely asset allocation, diversification, cost minimization, and behavioral discipline. The third major bias is loss aversion. This is perhaps the most deeply researched and most consequential of all the behavioral biases that affect investors. Loss aversion refers to the well-documented psychological reality that human beings feel the pain of a loss much more intensely than they feel the pleasure of an equivalent gain. Losing 100 units of currency feels roughly twice as bad as gaining 100 units feels good. This asymmetry is not rational. From a purely financial perspective, a loss of 100 and a gain of 100 are equal and opposite. But from a psychological perspective, they are profoundly unequal. The pain of loss is much stronger than the joy of gain. The implications for investing are significant and dangerous. Loss aversion means that when markets fall and your portfolio shows losses, the psychological pain is often intense enough to override your rational understanding that markets recover and that you should stay invested. Even investors who intellectually understand every principle of long-term investing, who know that they should hold on through market downturns, often find that the emotional pain becomes unbearable and they sell their investments anyway. They tell themselves they will buy back in when things stabilize. But of course, things always look worst at exactly the bottom of a market cycle, which is exactly when loss-averse investors are most likely to sell. And by the time things look stable and safe again, markets have often already recovered substantially, and the investor who sold has missed a large portion of the rebound. Bernstein addresses loss aversion directly by emphasizing that your asset allocation should be one that you can genuinely live with through the worst of times, not one that looks optimal on paper but will cause you to panic in reality. He makes a point that is worth repeating. Your true risk tolerance is not what you think it is when markets are calm and your portfolio is growing. Your true risk tolerance is revealed by how you actually behave when your portfolio has fallen by 40 out of every 100 of its peak value, when financial news is announcing economic catastrophe, when people around you are telling you to get out before things get worse, when every instinct you have is screaming that it is time to sell. If your current portfolio would cause you to sell in that scenario, your portfolio is too aggressive for your actual temperament. And a more conservative portfolio that you genuinely stick with will almost certainly deliver better long-term results than a more aggressive portfolio that you abandon at the worst possible moment. Be ruthlessly honest with yourself about this. The fourth significant behavioral challenge is the constant noise of the financial media. Financial news is specifically designed to be attention-grabbing, alarming, and emotionally engaging because these properties attract viewers, generate advertising revenue, and keep people coming back for more. If financial news simply reported that markets moved a little today and that long-term investors should continue to do exactly what they were doing, it would be accurate, but no one would watch it. Instead, financial news amplifies every daily movement into a crisis or a celebration, finds experts who confidently predict dramatic near-term moves in either direction, and creates a sense of urgency around investment decisions that is almost entirely manufactured. For the long-term investor, the vast majority of financial media content is not just unhelpful, it is actively harmful. It creates a sense that you need to be constantly monitoring your portfolio and making regular adjustments in response to the daily news flow. It suggests that there are knowable short-term market movements that smart people can anticipate and profit from. Both of these suggestions are false, and acting on them destroys investment results. Bernstein is quite frank about recommending that long-term investors dramatically limit their consumption of financial media. The best response to most financial news, for most investors, is to do nothing. Look at your allocation once or twice a year. Rebalance if needed. Add to your portfolio regularly with each paycheck. Otherwise, ignore the noise. This is not indifference or laziness. This is disciplined, evidence-based investment behavior at its finest. Now let us turn to what Bernstein calls one of the most important determinants of long-term investment success, the level of costs paid. Investment costs are not glamorous. They do not appear in financial news. Nobody gets excited about discussing expense ratios. But Bernstein is emphatic that costs are one of the most powerful levers available to investors, precisely because they are one of the few things in investing that investors can control directly. Every fraction of 1 unit out of every 100 that you pay in investment fees is a fraction of 1 unit out of every 100 that does not compound and grow in your portfolio. Because investment returns compound over time, even tiny differences in annual costs accumulate into enormous differences in final wealth over long investment horizons. Let us think about a specific example to make this concrete. Suppose you invest over 30 years, and your underlying investment generates an average return of 8 out of every 100 per year. If you invest through a low-cost index fund that charges only 2 out of every 1,000 per year in fees, you capture almost the full 8 out of every 100 return. But if you invest through an actively managed fund that charges 1.5 out of every 100 per year in fees, you capture only about 6.5 out of every 100 per year. This difference of 1.33 out of every 100 per year might not sound dramatic, but compounded over 30 years on a substantial investment, the difference in final wealth is enormous. An investor who paid the higher costs could easily end up with 30, 40, or even more out of every 100 less total wealth than an investor who paid the lower costs, despite starting with the same amount, contributing the same amount regularly, and earning the same gross return. The money that went to fees did not just disappear in any given year. It failed to compound for 3 decades. That compounding is the real cost of high fees, and it is devastating. This mathematical reality explains why Bernstein is such an enthusiastic advocate for low-cost index funds and such a sharp critic of high-fee active management. Index funds, which simply track a market index without employing active managers or conducting expensive research, typically charge only a small fraction of 1 out of every 100 per year in expenses. The cheapest and most widely available index funds from providers like Vanguard charge expenses in the range of 3 to 15 out of every 1,000 per year, sometimes even less. Active funds, which employ teams of analysts and portfolio managers attempting to outperform the market, typically charge much more, often 1 to 1.5 out of every 100 per year, or even higher. The devastating reality for investors in active funds is that they pay these higher costs not for guaranteed outperformance, but for an uncertain and historically unlikely chance of outperformance. The data is unambiguous. After accounting for fees, roughly 80 out of every 100 actively managed equity funds underperform their benchmark index over periods of 10 years or more. And the small minority that do outperform in one period show very little persistence in the next, making it essentially impossible to identify them in advance with any reliability. The implication for investors is stark and clear. Paying high fees for active management is, in the vast majority of cases, and over the long run, a poor investment decision. Low-cost index funds that simply deliver market returns minus a tiny fee consistently outperform the majority of active funds after all costs are accounted for. This is not a theoretical argument. It is backed by decades of rigorous empirical research across many markets, many time periods, and many categories of investment. It is one of the most robustly documented findings in all of financial economics. And yet, the active fund industry manages trillions in investor assets because investors do not know the data, are attracted to the promise of beating the market, or are advised by professionals who earn more by recommending higher-cost products. Knowledge is your protection against this. Now, let us move to the practical question of how to actually construct an intelligent portfolio, because everything we have discussed so far leads to this critical, practical question. How do you take these principles and turn them into a real investment plan that you can actually implement and maintain? Bernstein walks through this process methodically and practically. The foundation is a clear assessment of your own situation. Before choosing any investments, you need to answer 4 fundamental questions about yourself. The first question is, what is your time horizon? When do you need to begin using this money? Is it for retirement that is 30 years away? For a house purchase in 5 years? For your children's education in 15 years? Different time horizons fundamentally change what is appropriate for you. Money you need in less than 3 to 5 years should not be in stocks, because a major market downturn could devastate the value of that money at exactly the time you need it. Money you will not need for 20 or 30 years can and should be invested aggressively in diversified stocks, because you have the time horizon to ride out multiple market cycles and capture the higher long-term returns that stocks offer. The second question is, what is your true risk tolerance? Not what you think your risk tolerance should be, not what the questionnaire suggested, but what you will genuinely be able to tolerate in practice when a brutal bear market cuts your portfolio's value by 40 out of every 100 and shows no immediate sign of recovering. Be brutally honest with yourself here. Many investors dramatically overestimate their actual risk tolerance when markets are calm and their portfolios are growing. The third question is, what are your actual financial goals? Are you trying to accumulate enough to retire comfortably at a certain age? Are you trying to build a college fund for your children? Are you trying to build a cash cushion that lets you leave an unfulfilling job? Having specific, concrete goals makes it much easier to calculate what return you need, and therefore what level of risk you need to accept. The fourth question is, do you have adequate financial foundations before you invest? Do you have an emergency fund of 3 to 6 months of living expenses in stable, liquid, accessible form? Do you have any high-interest consumer debt that should be paid off before investing? Have you maximized your contributions to tax-advantaged accounts where they are available? These foundations need to be in place before substantial long-term investment makes sense. Once you have honestly answered these questions, you are ready to choose your target asset allocation. Bernstein recommends thinking about your allocation as a decision that you can live with across the full range of possible market environments. A useful mental exercise is to think about how you would feel and what you would do if your portfolio fell by 30 or 40 out of every 100 from its peak. If the answer is that you would maintain your discipline and perhaps even add to your investments, you can handle a more aggressive allocation. If the answer is that you would likely panic and sell, you need a more conservative allocation, even if the math suggests something more aggressive. Remember, the mathematically optimal portfolio that you abandon at the worst moment is far worse in practice than the slightly suboptimal portfolio that you actually maintain through all conditions. For a young investor with 30 or more years until retirement and a genuine high-risk tolerance, an allocation heavily weighted towards stocks, perhaps 80 or even 90 out of every 100 in diversified stocks, with 10 to 20 out of every 100 in bonds, has historically produced excellent long-term results. For an investor approaching retirement or someone with a lower risk tolerance, perhaps 60 out of every 100 in stocks and 40 out of every 100 in bonds is more appropriate. For someone in retirement or with genuinely low risk tolerance, 40 to 50 out of every 100 in stocks and 50 to 60 out of every 100 in bonds or other stable assets might be right. These are starting points, not rigid formulas. The important thing is to choose something that reflects your genuine situation and that you can honestly commit to maintaining. Within the stock portion of your portfolio, Bernstein recommends meaningful diversification across domestic stocks, international developed market stocks, and perhaps some exposure to emerging market stocks and to small company and value-oriented stocks. A simple three-way split of the stock allocation, with roughly half in domestic large company stocks, a quarter in international developed market stocks, and a quarter in small company or value-oriented stocks, captures the major categories in a reasonably diversified way. More elaborate splits are possible, but are generally not necessary for excellent results. For the bond portion, Bernstein generally favors high-quality government bonds of short to medium duration. These provide the most reliable stabilization during stock market downturns, which is the primary function of the bond allocation in most portfolios. Taking excessive credit risk or duration risk in the bond allocation undermines its stabilizing function without adequate compensation. Once you have chosen your allocation, the next step is selecting low-cost funds that implement it. Look for broad index funds in each asset class category with the lowest possible expense ratios. In the current investment environment, excellent index funds with expense ratios of less than 2 out of every 1,000 per year are widely available to investors in most major markets. These funds give you market returns in their respective categories at minimal cost. Avoid funds with high expense ratios, high sales charges, or complicated fee structures. Simple, transparent, low-cost funds are what you want. Once you have selected your funds and made your initial investment according to your target allocation, establish a schedule for ongoing contributions. Automating regular contributions from each paycheck is ideal because it ensures that investing happens consistently without requiring ongoing willpower or active decisions. Also, establish your rebalancing schedule. Decide in advance how often you will review your allocation and rebalance if needed, and commit to that schedule in writing. Speaking of writing, one of the most practical recommendations Bernstein makes is to write down your investment policy statement. This does not need to be a lengthy or complicated document. It simply needs to record your target asset allocation, the funds you have chosen, and the rationale for your decisions. Most importantly, it should include a section written specifically for your future panicked self. Write a note to yourself that acknowledges how you will feel during a severe market downturn, reminds you of the historical evidence that markets recover, explains why you chose your allocation and what you will do to stick with it even when things are scary, and clearly states that making changes to your allocation in the middle of a market crisis is almost certainly the wrong thing to do. Then, when markets fall dramatically and your emotions are screaming at you to sell, you can retrieve this document and read the calm, rational words of your past self. This simple technique has saved many investors from costly panic decisions. Now, let us discuss some practical considerations around taxes and account types, because these affect the practical implementation of your investment strategy significantly. In most countries, investors have access to some form of tax-advantaged account for retirement savings. These accounts offer meaningful tax benefits that can significantly improve long-term investment outcomes. In the United States, for example, traditional retirement accounts allow you to contribute money before it is taxed, and the investments within the account grow without being taxed each year, with taxes paid only on withdrawals in retirement. Roth-style accounts work differently, taking contributions from money that has already been taxed, but allowing all subsequent growth and withdrawals to be completely tax-free. Both types of accounts provide substantial benefits compared to investing in a standard taxable account. Maximizing contributions to these tax-advantaged accounts, to the extent possible within legal limits, is one of the most powerful things an investor can do to improve long-term after-tax returns. Beyond maximizing tax-advantaged accounts, investors who also hold investments in taxable accounts should think about which types of investments to hold in which types of accounts. This is what financial professionals call asset location. Investments that generate significant taxable income each year, such as bonds with regular interest payments, are often best held inside tax-advantaged accounts, where that income can compound without annual tax drag. Broadly diversified stock index funds, which generate relatively little taxable income in most years and benefit from favorable capital gains. Tax treatment, when eventually sold, can be relatively tax-efficient in taxable accounts. Getting asset location right does not transform a bad investment plan into a good one. But for investors with meaningful holdings in multiple account types, thoughtful asset location can meaningfully improve after-tax outcomes without any additional risk. Taxes should be managed thoughtfully within the context of your overall investment strategy, but they should not be allowed to override good investment decisions. Holding an investment that no longer fits your portfolio simply to avoid realizing a taxable gain is rarely the right decision. The after-tax benefit of correcting your portfolio almost always exceeds the cost of the tax bill. Now, let us discuss some of the important concepts around the timing and sequence of investment returns, particularly as they relate to investors who are approaching or already in retirement. For investors who are still in the accumulation phase, still adding money to their portfolios from regular income, market downturns are actually helpful in one important sense. Lower prices mean that each regular contribution buys more shares of your funds. You are dollar cost averaging at more attractive prices. This is not a silver lining to look for in bad markets. It is a genuine mathematical advantage of regular contributions during periods of depressed prices. For investors in or near retirement who are beginning to withdraw money from their portfolios, the mathematics work differently and more dangerously. This is where the concept of sequence of returns risk becomes critically important. Sequence of returns. Risk refers to the danger of experiencing significant negative investment returns early in retirement, during the period when withdrawals from the portfolio are just beginning. Here is why this is so dangerous. If a retiree's portfolio falls significantly in the first few years of retirement, while they are simultaneously making withdrawals to live on, they are selling investment assets at depressed prices. This reduces the number of units they own. When the market eventually recovers, they have fewer units to participate in the recovery. The portfolio may never fully recover to what it would have been if the sequence of returns had been more favorable. Two investors who retire at the same time with identical portfolios, identical investment allocations, and identical withdrawal rates can end up with dramatically different final wealth outcomes if one retires at the beginning of a good market period and the other retires at the beginning of a significant market downturn. The sequence of returns matters enormously for retirees, even when the average long-term return ends up being the same. Bernstein addresses this risk by recommending that investors approaching and entering retirement maintain a meaningful allocation to stable, high-quality assets that can be drawn down during market downturns without requiring the sale of stocks at depressed prices. One practical approach is to maintain enough in stable assets, such as short-term bonds and cash equivalents, to cover 2 to 5 years of living expenses beyond what regular income, such as pensions or Social Security, covers. During a market downturn, you draw on these stable assets for your living expenses while allowing the stock portion of your portfolio to recover without being forced to sell. Then, during periods of strong market performance, you replenish the stable asset portion by gradually rebalancing from stocks. This approach provides both practical financial protection and, equally important, the psychological security to avoid panic decisions during market downturns when you know you have a multi-year cushion of stable assets to live on. Now let us come back to a theme that runs throughout Bernstein's work and that he considers central to everything else: the importance of financial education and the profound damage done by financial ignorance. Bernstein is quite direct about the fact that the financial services industry as a whole profits substantially from the financial ignorance of its customers. High-fee investment products exist and thrive because most investors do not know that nearly identical low-cost alternatives exist and work better. Market timing newsletters and prediction services find paying subscribers because investors do not understand that markets are far more efficient than most people believe, making consistent timing virtually impossible. Complicated structured products with impressive-sounding names and projected returns find buyers because investors do not know how to evaluate them critically. Actively managed funds that consistently underperform their benchmarks after fees continue to attract billions in investment because investors do not know the data or do not know how to interpret it. All of this changes with education. An investor who genuinely understands the risk and return relationship, who understands the historical evidence for efficient markets, who understands the mathematical certainty of diversification's benefits, who knows what the data says about active management, and who understands the devastating compounding effect of high fees, is an investor who can no longer be easily taken advantage of. This investor asks the right questions. They demand to see expense ratios and total cost data. They are skeptical of past performance claims. They insist on understanding how an advisor is compensated before taking their advice. They choose simple, low-cost, well-diversified portfolios and resist the pressure to complicate them. Financial education is, in this sense, one of the most valuable investments you can make. It costs little or nothing, and it pays compounding dividends for the rest of your investing life. Bernstein also addresses the role of financial advisors, which is a topic worth spending some time on. Some investors, whether due to lack of time, lack of confidence, or complexity of their financial situation, genuinely benefit from working with a professional financial advisor. There is no shame in this, and good financial advice can add real value. But if you work with a financial advisor, Bernstein strongly recommends choosing one who is compensated only by direct fees from you, meaning they charge you an agreed amount for their advice and do not receive commissions or other payments from the financial products they recommend. An advisor who receives commissions from selling you investment products has a structural conflict of interest that can lead even well-intentioned advisors to recommend products that are better for their income than for your portfolio. A fee-only advisor who is compensated directly by you is far better positioned to give you genuinely objective advice that serves your interests. Even if you work with an advisor, having the knowledge that Bernstein provides makes you a much more effective participant in the advisory relationship. You can evaluate the advice you receive critically. You can ask intelligent questions about costs, about the evidence behind recommendations, and about how the advisor is compensated. An educated client is a protected client. Let us now talk about the realistic expectations that a long-term investor should hold for their portfolio, because managing expectations is an important part of managing behavior. Bernstein is honest about the uncertainty inherent in all investment planning. The historical record of stock market returns is compelling, but the future will not perfectly replicate the past. Returns depend on factors that change over time. Economic growth rates vary. Starting valuation levels affect forward returns. Demographic trends evolve. Geopolitical environments shift. There have been long historical periods when even well-diversified stock portfolios produced poor returns. Japan's stock market, to take the most dramatic example, reached its peak in late 1989 and spent the following 3 decades below that level. Japanese investors, who had expected the historical pattern of eventual recovery to apply to them within any reasonable horizon, were severely disappointed. Similar, though less extreme, extended periods of poor returns have occurred in other markets. The United States stock market itself went through a decade from 2000 to 2010, during which it ended roughly where it started, despite paying dividends along the way. This does not mean that diversified stock investment is inappropriate for long-term investors. It means that expectations should be held with appropriate humility, and that the longer your time horizon, the more confident you can be in capturing something resembling the long-term historical average return. For short horizons, anything is possible. For horizons of 20 or 30 years and beyond, the historical record provides more reassurance, though never absolute certainty. Bernstein also discusses realistic expectations for the impact of asset allocation decisions on long-term returns. The evidence suggests that asset allocation, meaning the mix of stocks, bonds, and other assets in your portfolio, is the single most important determinant of your long-term investment returns. Research consistently finds that asset allocation accounts for the vast majority of the variation in returns across investor portfolios over time. Stock selection and market timing, the two activities that most investors spend the most time and energy on, account for a much smaller portion of long-term return variation. This finding has a profound practical implication. The most important investment decision you will ever make is not which stock to buy or when to buy or sell. It is how to allocate your capital across the major asset classes. Getting that allocation right and maintaining it consistently matters far more than any specific investment selection decision. This is both liberating and humbling. It is liberating because it means you do not need to be a genius stock picker or a clairvoyant market timer to achieve excellent long-term investment results. It is humbling because it means that the activities that feel like investing, picking stocks, following financial news, reading analyst reports, making active trading decisions, are largely irrelevant to the thing that actually drives your long-term results. Let us now bring all of these themes together into a comprehensive and actionable picture of what intelligent investing looks like in practice. The intelligent investor begins with a clear-eyed understanding of their situation. They know their time horizon. They know their genuine risk tolerance. They have specific and realistic financial goals, and they have their financial foundations in order before committing to long-term investment. From this foundation, they construct a simple, broadly diversified portfolio using low-cost index funds. The portfolio spans multiple asset classes, including domestic stocks, international stocks, and bonds, perhaps augmented with modest allocations to real estate investment trusts or other uncorrelated assets. The proportions reflect the investor's genuine risk tolerance and time horizon. The funds selected have the lowest possible expense ratios, almost certainly well below half of 1 out of every 100 per year in fees. The investor invests regularly, ideally through automatic contributions from each paycheck, maintaining the discipline of dollar-cost averaging without requiring active decisions. The investor reviews the portfolio at most once or twice a year, rebalancing back to target allocation when any asset class has drifted significantly. Between reviews, the investor ignores financial news, avoids checking the portfolio value frequently, and resists any temptation to make changes in response to short-term market events. The investor has a written investment policy statement that records all these decisions and commitments and includes a message to their future self for the next time the market falls dramatically. And through all of this, the investor maintains a long-term perspective, measured in decades rather than years, and trusts in the compounding power of patient, disciplined, low-cost investment to do its work over time. This is not a recipe for the fastest possible wealth accumulation. It is a recipe for the most reliable and most sustainable wealth accumulation available to ordinary investors. It eliminates the most costly mistakes. It captures the genuine long-term returns that well-functioning markets have historically delivered. It does so at minimal cost. And it requires far less time, attention, and expertise than most people assume investing demands. Let us now talk about the concept of compound growth more deeply, because it is perhaps the most important mathematical principle behind long-term wealth building, and Bernstein wants investors to understand it at a visceral level. Compound growth means that the returns you earn each year are added to your principal, and then the following year's returns are earned on the combined total, including all previous year's earnings. In the early years of investing, this process works slowly and is not very dramatic. After 5 years of investing, even at decent returns, your portfolio might not look dramatically different from what you put in. But as time passes, the compounding effect becomes increasingly powerful. After 20 years, returns are being earned on a much larger base. After 30 or 40 years, the compounding effect becomes truly extraordinary. The difference between the final wealth of someone who starts investing in their 20s and someone who waits until their 40s, even if the late starter invests much more per year, is often dramatic enough to seem almost unbelievable. This is because the early investor's contributions have much more time to compound. The returns earned in the early years have decades to themselves compound and generate further returns. Those early years of compounding, when the numbers are still small and unremarkable looking, are actually the most valuable years of all, because it is during those years that the foundation for the truly dramatic later growth is being built. This is why Bernstein is so emphatic about starting to invest as early as possible. Even modest amounts invested early in a working life, through the miracle of long-term compounding, can grow into wealth that seems disproportionate to the original investment. Time is the most powerful ingredient in the compounding recipe. Do not waste it by waiting until you feel completely confident, until your financial situation feels perfectly stable, or until you have fully mastered all the concepts. Start with what you have and what you know. Keep learning, and let time do its work. Let us now reflect on some of the broader philosophical underpinnings of Bernstein's approach. At its heart, intelligent asset allocation is built on a particular view of financial markets. Bernstein believes that financial markets are, in the long run, and for the most part, highly efficient. By this, he means that the prices of financial assets, like stocks and bonds, generally reflect all available information fairly quickly and reasonably accurately. News about a company's prospects is rapidly incorporated into its stock price. Information about economic conditions quickly affects bond prices. The combined wisdom and actions of millions of investors with different information, different analyses, and different views collectively process enormous amounts of information and produce prices that are, most of the time, reasonable estimates of true underlying value. This does not mean markets are perfectly efficient at every moment. They are not. Bubbles form and crash. Prices can deviate substantially from fundamental value for periods of time. But identifying these deviations reliably and profitably in advance, before the market corrects, is extraordinarily difficult, even for the most sophisticated and best resourced investors. The evidence strongly suggests that most investors cannot do it consistently, and the costs of trying are high. This view of market efficiency leads directly to Bernstein's practical recommendations. If markets are mostly efficient, trying to pick individual stocks that will outperform is mostly a futile exercise. If information is quickly incorporated into prices, trying to time the market based on publicly available information is mostly futile. If even professional investors with vast resources cannot consistently beat the market after costs, ordinary investors should not try. The rational response to an efficient market is to capture the market's return as cheaply as possible, which means index funds. This is not a passive or lazy approach. It is the most evidence-based, most rigorously supported approach to investing for ordinary people. Bernstein also addresses the occasional objection that market efficiency cannot be universally true because some investors do beat the market. This is true. Some investors do beat the market. But here is the critical point. In a zero-sum game, where one investor's gain is another's loss, some investors must beat the average by definition, because the average includes the winners. The existence of some investors who beat the market does not tell us that skill, rather than luck, is responsible. Research on the persistence of investment performance suggests that the majority of outperformance can be explained by random variation. The funds that outperform in one decade are no more likely than chance would predict to outperform in the next. And identifying in advance, before the fact, which funds will be among the outperformers is essentially impossible. So the rational investor does not try. They simply capture the market return at minimal cost, knowing that this will outperform most active managers over time. There is something liberating and clarifying about this realization. It frees you from the anxiety of wondering whether you are picking the right stocks or the right funds. It frees you from the exhausting work of constantly monitoring financial news and analyst opinions. It frees you from the expensive habit of frequent trading. And it redirects your energy toward the things that actually matter, namely your savings rate, your asset allocation, your costs, and your behavioral discipline. Let us now take a careful look at one more critical area that Bernstein addresses, which is the relationship between your investment portfolio and your overall financial picture. Many investors think of their investment portfolio in isolation, as a separate compartment of their financial life. But Bernstein wants you to see it as part of a larger whole. Your overall financial position includes not just your investment portfolio, but also your human capital, your future earnings potential, the equity in your home if you own one, your anticipated pension or Social Security payments, and the stability or volatility of your job and income. These factors should influence how you think about your investment portfolio. A young person with a stable government job, a guaranteed pension, and 30 years of future earnings ahead of them has a very different total risk profile from someone who is self-employed in a cyclical industry with no pension and variable income. The person with stable human capital can afford to take more investment risk in their portfolio because the stability of their income provides a natural cushion. The person with volatile human capital should perhaps be more conservative in their investment portfolio because their income itself is already a risky asset. Similarly, a person who owns a home in a particular city has concentrated exposure to the real estate market in that city. They may not need to add additional real estate investments to their portfolio because they already have significant real estate exposure through their home. Thinking about your investment portfolio as part of your complete financial picture, rather than in isolation, can meaningfully improve the quality of your asset allocation decisions. The goal is not just to optimize the portfolio on paper, it is to optimize your entire financial position, taking into account all of your assets, income sources, obligations, and risk exposures. Now, as we approach the conclusion of our journey through Bernstein's framework, let us take stock of everything we have covered and consider what it means for you as an investor going forward. You now understand that risk and return are fundamentally and inseparably linked. Higher expected returns require accepting higher risk, and this is not something to fight against, but something to use intelligently in building your portfolio. You now understand that diversification across imperfectly correlated asset classes is the single most powerful tool available to investors for improving the risk-adjusted return of a portfolio. You understand why combining domestic stocks, international stocks, bonds, and potentially other asset classes in a thoughtfully constructed portfolio produces better long-term outcomes than concentrating in any single asset class. You now understand the history of major asset classes well enough to calibrate your expectations realistically. Stocks offer the highest long-term returns with the highest short-term volatility. Bonds offer lower returns with lower volatility and important stabilizing properties. Cash is safe in nominal terms, but a slow-motion destroyer of real purchasing power over long periods. You now understand why rebalancing is not just maintenance, but is actually a disciplined value-adding activity that forces you to sell high and buy low systematically. You now understand the devastating long-term impact of investment costs and why choosing the lowest possible cost index funds is one of the most reliable things you can do to improve your long-term returns. You now understand the behavior gap and the many psychological biases that drive it. You know about recency bias, overconfidence, loss aversion, herding behavior, and the noise of financial media. And you understand that the best protection against these biases is the kind of deep, grounded knowledge that makes market volatility understandable rather than terrifying. You now understand the practical steps of building an investment plan, from assessing your situation and choosing your asset allocation, to selecting low-cost funds and establishing rebalancing habits, to writing down your investment policy and committing to maintaining your discipline through all types of markets. And perhaps most importantly, you understand that investment success does not require genius, special information, or extraordinary skill. It requires understanding these principles, applying them consistently, keeping costs low, and having the patience and discipline to maintain your plan through the inevitable short-term difficulties that financial markets always produce. This is the wisdom that Bernstein has distilled from decades of deep engagement with financial research and history. It is a wisdom that is accessible to anyone willing to invest the time to understand it. It is a wisdom that, once internalized, transforms your relationship with financial markets from one of anxiety and uncertainty to one of calm, informed confidence. The markets will continue to do what they always do. They will rise for periods. They will fall for periods. There will be moments when the news is frightening and the future looks dark. There will be moments when everything is exciting and the temptation to add risk is powerful. In all of these moments, the principles you have absorbed today will serve you. They will anchor you when the winds of market volatility try to blow you off course. They will remind you of the rational decisions you made when you were thinking clearly, before the emotions of a market crisis clouded your judgment. They will give you the confidence to hold on through the difficult periods, knowing that patience has always been rewarded by the evidence of history. The path to lasting investment success is not secret. It is not complicated. It does not require talent, connections, or luck. It requires understanding, discipline, patience, and the wisdom to do the simple things consistently, even when everything around you is screaming that you should do something complicated instead. William Bernstein spent years synthesizing the best of financial research and history into a framework that any ordinary investor can use. That framework is intelligent asset allocation, and now you have it. The only thing left is to apply it. Start with where you are, with what you have, with what you know. Build your plan, write it down, automate what you can, and then give it the most powerful ingredient of all, time. Because in the end, wealth building is not a sprint. It is not even a marathon. It is a lifetime journey, walked one consistent, disciplined step at a time. And the investors who understand this, who commit to the journey, and who do not try to shortcut it with clever tricks or risky bets, are the investors who ultimately arrive at financial security and freedom. That is the promise of intelligent asset allocation. And it is a promise that the evidence of history suggests you can genuinely count on, provided you have the wisdom, the patience, and the discipline to honor your commitment to it. That wisdom is now yours. Use it well, and let the power of time and compounding do the rest.